Well, some say that Jerome Powell turned dovish in December. Others say Powell was right in hinting at 3 rate cuts in 2024. Others say the Fed chief has jumped the gun. But all we know is that the Indian markets have been jittery today. The FOMC minutes are going to be released soon, and the benchmark Nifty has slipped below 21,550. What lies ahead in our markets, and what lies ahead specifically on the 4th of January? Let's decode it. Market expert Ajay Bagga joining us to break down the sell-off that's underway in the markets and what global cues like the FOMC's minutes can do to change the course of the markets. Welcome to India Tonight. Always a pleasure, Ajay Bagga. This sell-off that we are seeing at the start of the year, this nervousness that we are sensing, what do you put it down to? Is this about valuations? Is this about Q3 earnings? Is it about weakness in global growth, or do you think it's mere seasonality? Are we in the midst of a correction, you think, or is there more to it?
I think seasonality, Vikram, not much to be read into this week's market moves. I would say next week is when we will get a stronger trend. This is a week of enhanced volatility. Japanese market is shut. A lot of fund managers normally come back by Jan 10th or so from their annual vacation. So we really get a flavor of how the year will pan out by the second week of January. So this was on expected lines. Last week when we spoke towards the end of the year, I was quite, I won't say confident, that's a wrong word, but I was quite sure that Santa came early to the markets and there'll be a slight New Year's hangover for the markets. We were euphemistically looking at sideways market. They've corrected, and it's a global correction. So that worries investors normally, Vikram. But what I would say, this is seasonality. This week I would not read too much into the market moves. Let's see for next week. As far as the FOMC minutes go, you were very correct in characterizing Powell, did he pivot too early, or did the market force a pivot onto him? If you look at the press conference and the dot plot, they were talking of 3 rate cuts in this year. The Fed futures is sitting on 6 rate cuts. The ECB, with a 3.9% inflation, is sitting on an ECB futures curve, which is showing 6 rate cuts in 2024. So market got a little bit of over exuberance post December 13th, and it became a one-way market. We saw a very sharp rally. Now a little bit of that is getting consolidated into. I don't see a very deep cut coming, but we'll get better ideas by next week.
For the moment, of course, we are kind of trained on what could happen when the minutes of the last FOMC meeting that took place in December, those come out later. A cut in American interest rates, though, and if that happens soon, it could turn the tide on Dalal Street, don't you think? Because that means foreign investors would favor India as a destination. And if that is the case, Ajay Bagga, do you expect any further indication of the potential timing of rate cuts in the minutes of the FOMC's December meeting? Because the minutes come out later.
Yeah, you will not get any indication. As he said in the press conference, we have not talked about rate cuts, though the dot plots are showing 3 rate cuts. The timing or the magnitude, I don't think you will get any clarity on that further to what the market has already got. What we will get to see is that a large majority of the voting members were dovish. So that should give the market some legs. But Vikram, I think that has got priced in already in the run up from 13th December to the end of the year. So a lot of that got hastily priced in and maybe overpriced in. So today, I'm not expecting much bounce. What you are seeing rather is a little bit of the steam going out. Very correct to say that when the dollar weakens, and the dollar will weaken when the Fed pivots or the market anticipates that a rate cut is coming. That is very strongly correlated to emerging market flows increasing. And within emerging markets, India is an overweight for large wirehouses. So we are expecting a good amount of inflows to come to India as the dollar weakens and as the Fed rates go down. It's very logical. The risk-free rate starts going down. You start looking for yields, and India is a very attractive macro and an attractive market for these flows, some part of these flows to come in. The US money markets are sitting on about $6 trillion of money market funds. That's not going to come into equities. Those are asset allocation wise money market funds, but a portion of it was parked. Seeing the 5.25%, you could make risk free. That portion will start coming to emerging market flows, and a portion, sub portion of that will come to India.
Well, right now, if you look at what's happening in the US markets, if you see the action on Wall Street, we are seeing a sea of red. The Dow Jones is down about 0.4%, and look at the Nasdaq as well, which took quite a drubbing in a trade yesterday. Now 0.6 percentage point further cut coming in on the Nasdaq as well, and the S&P is down by 0.5 percentage point. So a sea of red, where you talk about the action unfolding before the minutes come out. But Ajay Bagga, it would be important to consider the possibility of a rebound in the American benchmark 10-year bond yield. If that goes up and there is an uptick in the dollar index, what do you expect the Fed to do? Chances are they may not turn as dovish and start cutting interest rates, right?
No, I would say rather that the bond market is anticipating the Fed rather than the bond market, pushing the Fed's hand, Vikram. If you see, the 10-year yield went all the way near to 5% and came down to about 3.6 odd, and now again it is skirting 4%. The dollar index, the DXY, went down to 100.6. Now it is again above 102. And the last 2 days have been very good days for the dollar strength. And all the risk assets, as a result, are getting priced downwards, starting from gold and Bitcoin, both of which fell. So the Fed will not look at the bond market. The bond market is over exuberant. It's talking of 6 rate cuts, while the Fed is very circumspect and saying 3 rate cuts. What is changed? The last 6 months, Fed indicator, the PCE inflation indicator has come in, the trailing last 6 months has come in below 2%. The November PCE inflation month on month was below 1%. And that's the favorite indicator of the Fed. They would have had a lot of that data with them. That will be critical to see if any mention of that is there in the FOMC meet. And they say, even if they don't say 6 months, if they say, okay, 5 months trailing is already near 2%. So we are very much near. And remember what they said at the meeting, two very critical points for the market. One, they said we will not wait for a recession. Normally, you saw an economic downturn and then we start cutting rates. This time it's a normalization. So we have gone ultra restrictive to break the backbone of the inflation, and we will normalize. It's not a reaction to the recession. They were saying they're hoping for a soft landing. The second big thing, what Powell said at the press conference, we will not wait for 2% to be hit. We will start cutting before that. So Vikram, if this inflation data you add to the FOMC minutes, that's where you come to the March rate cut probability of 80%. That's why the market got so exuberant. Now, these minutes are backdated, so let's see what comes out. I think most of it is known. What will be more critical is, say, Barkin speaks today. One of the Fed governors, Barkin, speaks today. Again, he speaks on Friday.
Yes.
I think that will be more setting for the markets, Vikram.
We'll watch out for that. But for the moment, when you turn to our own markets, one believes that most of the positives have been factored into this current market setup, whether it's good credit growth, the manageable inflation, the stability in the economy right now. And if it's all priced in, then this kind of weakness that we are seeing in the markets, we'll have to see the next week's action unfold. Until then, whether we are going to see more profit booking, whether we are going to see more participation in the bull run that we've seen in the recent past, that is something that is at play. And of course, what comes out as global cues as well. All of which, of course, we'll check in with you again and again. But thanks very much for joining us with your version of what you see in the markets and unfolding as the FOMC's minutes come out later tonight. Thanks very much for joining us, Ajay Bagga.